Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, August 2nd, 2023. It is 12:09 p.m. Eastern Time as I'm starting the video. As usual, I'll start out with the equity markets and just kind of go over some of the things I'm watching. We're starting to see quite a bit of, or at least I've seen quite a few breakdowns today. As I mentioned, as I do these videos and I'm covering an individual sector, whether it's the semiconductors or the restaurant stocks more recently, things like that. I'll set those price alerts and I'll tell you that quite often, it's like popcorn going off one day, just out of nowhere. You start getting bing, 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 all these alerts, with the chimes going off. And that's what happened. I had quite a few, which I got out to you. And so I'm going to go over those as well, because those are all individual trade ideas. But let's start out with the market, because I know from the comments, I know from doing this for a long time, nobody wants to short. We got a comment yesterday under the restaurant video. Oh, I won't short the restaurant stocks till the market breaks down. Well, look, as I've said, and I think it's been documented in the media, it's been a stock picker's market for the last couple months, and it could continue to be that, or we're getting really, really this rally to say the rally in the Nasdaq and big tech is getting long in the tooth. That'd be a gross understatement. So where I'm going with that is, when you see the reversal of that trade, when a trade has a lot of hot air, and there's strong technical and fundamental cross currents, that's when you can get that swift rush for the exit. So I think the only thing that's going to hold the market up between today or this week is Apple and Amazon, both reporting Thursday after the close. And maybe the market will like what they're selling, and God forbid if it doesn't, the rush for the exits could be very, very crowded. So, what we're seeing today, I think, and I haven't even read the headlines. Slept in. I'm coming down with something. I was up most of the night. I don't know what it is, some kind of fever and chills and all that. But just trying to catch up on things and not having scanned the headlines. What I believe it is today, I did see yesterday that Fitch, I think it was, downgraded U.S. Treasury, U.S. debt from AAA to AA plus. That's happened before. I've seen it happen years back. But, citing all the reasons we know, excessive debt, constant last minute negotiations and with the debt ceiling. Here's the thing. Fundamentals don't matter until they matter. I like to say that's kind of my yogiism I use. And same thing with technicals. These divergences and overbought conditions and, other extremes, they don't matter until they matter. And then one day they just start to matter. So I think that's what's going on today. And we'll get to that. We'll look at treasuries. Let me look at QQQ real quick and I'll move on. So there's the BOD, what I call my BOD, benefit of the doubt trend line, and that's because you have all these reactions along here. And so we're at that right now. And I'm gonna put a second line here. We're also at price support. I gave you a 15-minute chart today, and that's similar. So actually we're right there. We're a hair below it, but give or take, we have some support here. In 3 seconds or less, my thought is we're going to bounce today soon. Unless you're in market meltdown mode, and that's far from what we're in right now. We're coming off extreme, a very strong uptrend. About the extreme I usually see is a 3% down day for QQQ and SPY as well. We're down 2.5 right now, so I think the downside's limited. Dip buyers, as they will probably come in and buy this dip up today. But I have to say that with a little bit of caution. Let me show you why. Let's dive into the charts. Here's where we're at right now. So this is that uptrend line on QQQ. Been talking about forever. We took out the trend line on NQ already, but we've been kind of chopping through the NQ, the Nasdaq 100 future trend line, and we took out this one on QQQ. So we were here this morning, 375.40. Pretty good support, and we took that out. We went right on through there. And that's a little bit surprising. Usually you'd think you'd get one last hurrah off the trend line, but we're talking, it's not much more. We're talking, this is a 300, almost 400 point security. So almost every 4 points is only 1% on QQQ because of the where it's at. So it's not much, and this is the next support level. But again, the most important thing is we're starting to crack this today. And again, take it with a little bit of a grain of salt because you have Apple and Amazon on Thursday. I, in the last couple of weeks, I told you my expectation is you would see some nervous selling, some profit taken out of the big fangs leading into earnings. And as I've gone over so far, I have more crosses or check marks for the bearish case on my earnings calls than I do pluses or X's. We'll go over that real quick, tell you what I'm talking about. So Apple has not yet reported. Again, Apple and Amazon report Thursday after the close this week. Apple broke down here, but again, it's a pre-earnings breakdown. Everything else was reporting. And so what they did, they backtested, and went up, made a new divergent. This divergence has been building, starting to roll over. But again, you can't put too much into that until they report. Now, if they report, it has the potential to come on up here, burn through these divergences, or build on this. Again, I've made my thoughts very clear for weeks now. And if a chart is clearly bullish or bearish, not the trend. Everyone, 99.9% of people we talk to say Apple is super bullish right now. That's the trend. I don't, that's hindsight stuff. If you want, to be told what's going up right now, you don't need to join a site like this, where I'm giving analysis. I call it right side of the chart because I'm only concerned about what happens here going forward, not here. Anybody can tell you this is an uptrend. So to me, this is a bearish technical posture despite a very powerful and strong uptrend. And therefore, I think the post-earnings move, and again, whether it's in the after-hour session or not, that doesn't mean anything to me. We're really talking next week because they're going to report Thursday night. Friday's the first full trading day. We'll probably have a decent idea, but then, of course, market shuts down at Friday. Even the futures shut down for the weekend. Don't pick back up till Sunday evening. So we won't know for sure which way this thing's going until next week. But I already shared my thoughts and where I think it's going. And I guess the takeaway here, again, without trying to be redundant, is anything's possible. But if at this point in time, a sudden and swift drop is more probable than it usually is because of the extreme conditions and everything else going on that I'm going to cover in this video. Interest rates being one of those, the downgrade in U.S. Treasury bonds. And so all I'll try to tell you is don't underestimate just how fast an overcrowded trade, how fast stocks can drop when they're part of an overcrowded trade. Even beloved Apple with its stock buybacks and tons of cash and blah, 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 blah. All right, so that's Apple. Again, we'll revisit it after they report. Microsoft earnings are already out of the way. This was a big check mark. You had that big, what I identified as a buying climax before earnings. There was our earnings date, and as expected, it's consistently sold off following earnings and is now down from their earnings. The close, the day they reported, it's now dropped about 6% already. And, again, this looks like, to me, a top, not a, correction. Now, if it takes this level out, 324, that's going to be even more bearish. And, I've given you most of my targets, kind of swing or trend targets. If these technicals, the negative divergences, everything play out, then I think we're going down. A lot of stocks are going to visit their primary uptrend lines right here. You can see that on Microsoft, and that's quite a bit lower. In fact, let me measure it out. That would be, we're not going to go straight there. That would be a drop of about 21%. I'm going to give you another target right here. Very nice target right there, about 290, 360. I like that. You got a gap there, reaction high, major reaction high there, another gap, quite a few reactions. So these are, if you want swing targets, simple swing, traditional swing trades that you can tuck away for a few weeks, months if they play out. That's going to give you about a 10% drop to that first target and about a 20% drop to the second target. And if we do this, I will address it. If we start to rally, if the Apple and Amazon or whatever other forces start to bring this up, and maybe this is just a correction, a long overdue, I think we'll agree that even the most ardent bull has been open to the idea that we need at least a correction to work off the overbought conditions. So I will acknowledge that. So that's that. As of now, check mark divergences are playing out, and based on the scope of these divergences and other technical factors and fundamentals as well, I think this is only the start of a much bigger drop. We'll see. All right, Alphabet. Remember on this one, my preferred scenario before earnings was that we were right here coming into earnings, and I outlined a likely scenario of one post earnings pop to give us that nice, bigger, larger divergent high there, followed by a reversal. So far, work to be done, because to be right, we need to take out the where we close before earnings. But so far, so good. If we can build on this, and again, this is where this stock goes from here will likely depend on what Apple and Amazon do after they report. So you know where I think we're going, and there's a lot of downside to this one. Targets would be right here. I'm just going to measure them out in percentage terms. A drop about 5%. Next target would be about 10%, and then about 15%, and ultimately down to the trend line there, and that's about 21%. So there's a common theme here. That my preferred at this point in time as of today, and that could change next week, but as of right now, if you just kind of want an idea of where things might be going, I think that's it. I think work our way down, and also if you want timing, if you're an options trader, I personally not a big fan of options. I've traded them many times in the past, don't do it anymore, and the reason for that, as I always say, it's hard enough to get the call right on a stock, where a stock's going. That's one thing. It brings a whole nother degree of difficulty in to not only say where a stock is going, but when it's going to get there. In other words, is it going to go like this? Is it going to go like this? And ultimately get there, is it going to take 6 weeks or is it going to take 6 months? And there's a big difference, because if you're buying near-term options, because the premium's a lot smaller, you don't pay as much for them. You got to be right, or they don't pan out. So that's my take. Now let me give you my thoughts. Seasonality, everything coming up, technical posture. If I'm right, and this has just been a bear market rally and a pretty extreme or healthy one at that, but by many metrics still a bear market rally, then it'll probably happen very fast, because I've seen. I've been probably reading up more, in the financial media and trying to build a general consensus of where most go. And we're at that point, that whole return to normal. Here, let me show you. Here, this one's a little blurry when I zoom in. I'll just, this is a typical, I've shared this chart, and I didn't create this. There's plenty of iterations of this online, different versions of it. But this is, it tells you the stages of any bull market. And so if you want to consider this COVID right here, okay, COVID to me was a correction. Even what we've seen so far, the first big drop was a correction. I believe the leg down into the October lows in the stock market. So this was a bull market. Let's just say that was COVID. The drop there was what I nicknamed a Ursa interruptus, is what I give it. A bear market interrupted. The Fed didn't allow a bear market, even though it was a 36% drop in the S&P 500. Still, to me, it was a correction. Only lasted 6 weeks, and then Fed, juiced the market up. And that's what happens at the end of most bull markets. It happened in 2000, looked just like this, the dot-com bubble. And then you get that first wave down, bull trap, and you get this return to normal. That's where we're at right there. And I can tell you this, factually, that just a week ago, the Fed came out and now has, for the first time, the Fed has officially announced they no longer think there's going to be a recession. That, to me, is probably one of the best sell signals on the market you could get. The Fed is they're like mush from that movie A Bronx Tale. If you guys saw that movie years ago with Robert De Niro, he was everything the guy would bet on went the other way, and the Fed is just almost you can almost count on them to be wrong on their recession calls, their calls on inflation, being too late to the always reactive and doing too much on either way, whether they're hiking or cutting rates. Anyways, and then you've had some of the big firms recently also capitulate and abandon their recession calls now. So, and it's really accelerating in the last few weeks. So whether or not this pans out, I can tell you this now feels more like that return to normal, where the vast majority, it seems, the consensus is now, and I'm talking about Wall Street firms, analysts, even comments that I see a lot of times in the website here, is thinks we're going to new highs, and at best, we're going to have a correction and no recession coming, and that's a very contrarian thing. So, anyways, that's where we're at on the roadmap. And again, what I've been trying to impress, and for a long time, is that do not underestimate if that is correct. And I know you're listening to this. Well, Randy, what do I do with that? Do with what you want, but my takeaway would be if you are bullish long, you have investment, you have, let's say, long-term funds, 401k, all that kind of stuff, or even your trading account, and you believe that the market's going to go higher and that that's we're going to have a correction, don't fall in love with those positions. Just use a stop. Don't underestimate is what I'm trying to say, just how far and how fast, because if that is the case, if, again, big if, and we're here, typical primary waves, if you're an Elliottian, those that use and study Elliott wave theory, you get the initial leg down on a 5-wave cycle. That's wave 1. Wave 2 is your first counter trend. That would be consider off the October lows in the stock market. And then P3, your primary third wave, is usually the strongest, and there's a fourth up and then a fifth down, and then that's a primary wave count. But this is, and I've seen it play out a lot. I don't fully subscribe to Elliott wave theory, meaning believe in it, only because it's so subjective to hindsight revisions, and that just crushes you. You can continue to look at a wave count and change it over. Again, the bulk of it is, a lot of the aspects of it do work. Typical corrections are usually a 3-wave ABC against a primary trend, things like that. And so, anyways, that's it. Hopefully, that's the point I want to impress, is that, where's the catalyst going to be? I've given you potential catalysts. If we're going to have a big leg down, Apple, Amazon, and I've been harping on just recently for the last few weeks, which we're going to segue into in a second here, Treasury bonds. I told you that is the other thing that I've seen. The vast consensus is, and I don't see anybody. I mean, I'm sure there's people out there like me, but all along I've been saying, look, we're probably seeing rates we probably started a new secular bull market for interest rates, meaning that would be a secular bear market for bonds. I think we're going a lot higher. It's hard to call the zigs and zags, but we'll try. And I've given you levels just recently, and that's the thing. And I said we're in a very precarious position on Treasury bonds because they're flirting with breaking out. Yields are flirting with breaking out to multi-year highs. And I can all but promise you, I always say I can't promise anything in this game that we call the stock market, investing, trading. I won't make a promise I can't keep, but I can come as close to promising you anything, is that if Treasury yields we get another surge up, considerable ramp up, we break out, the stock market is probably going to come down very hard. It's not going to tolerate that because there is a vast consensus seems to be that the Fed is done. At best, maybe one more quarter point hike, but the Fed funds futures, everything else, pricing in the fact the Fed's probably done. And that seems to be the general consensus. And when the general consensus is all thinking one thing and then something else happens, then there's a whole quick paradigm shift, and that can happen very fast, where institutions all of a sudden realize they were wrong. They're going to have to reduce equity exposure, pension funds, hedge funds, individual investors, again, with the rally that we've had and the hot air and fundamentals. I don't speak on that every day. The Schiller PE ratio and other valuation metrics of the market, many stocks, there's not a lot of margin for error right now. Best case scenario, this market and the economy keeps humming along, and maybe we, have a little bit of upside over the next year or so. But as I've been saying for months now, the risk reward is very poor. There's, in other words, in my opinion, limited upside compared to the potential for the downside if these fundamentals, that the things I'm watching, play out. Okay. All right. So that's it. There's your alphabet. Where I think it's going. Initial call was a pop followed by a drop, so that's yet to be seen. Amazon, Thursday reporting as well, so which is tomorrow, of course. Below trend back test. Again, take the breakdown with a grain of salt, but made it very clear based on the technical posture, especially these divergences steepening as of lately. In other words, the slope of the lines have increased, the negative slope, and that's that divergence right there. We've been diverging for a while. There's your uptrend line off the lows. We're already below it, breakdown, back test. So, from a pure technical, if there were no earnings, it would be a hard, pretty hard short for me right now on Amazon and the markets. But that's it. Amazon's flirting with, I think I must have color coded this level recently, 126.37. That's the big level. So tomorrow, if we take that out, especially close down below there after they report, really into Friday is going to matter. That's when the big boys, institutions really come in to play. Amazon, there's just not a lot of support below. That's what I'm seeing the same thing. I'm going to tweak right there and give you a first target. I'm going to just name it T1 now. So I'll do an update next week. And so that would be my, I don't want to call it minimum target because I have support about 123. But let's just say currently my preferred initial swing target right there. And that's a drop of about almost 10%. Next one is right there, 104. And that's 18%. So there's that common theme. As I go through all these big things, I'm seeing the same thing. I can draw a trend line off the lows right there. I'm looking at initial drops of about 10% in these market leaders, which would also correlate to a 10% or so drop in the market because of their weighting. And then next stop about 20% down. NVIDIA, they don't report until the 23rd, so they've got a way to go. But we're seeing that, I've been doing updates on the semis and telling you the semis of all things, of the indexes, listing the triple Qs as my favorite index to short, but then also saying my preference because there were certain subsectors within there that XLF, if you want an ETF, with a little more concentration on what I think will go down more, and then of that, XLK, my bad, guys. Like I said, I'm a little under the weather today. XLK, Tech ETF. And then ultimately the semis, SOXX, is being my top pick within the tech sector. So semis, then XLK, and then QQQ. When you walk up here, this spectrum, if you will, this is a very highly concentrated area of tech. They're usually the canary in the coal mine for the tech sector, the semis, and then you have tech up here, which is big tech, everything, and then QQQ, which has tech over 50% in the NASDAQ 100, but it also has other things like healthcare and biotechs and other things, so it's more diversified. So this is a more conservative play. And these are more concentrated. So you have higher beta on these guys. If I'm right, you're going to make more money on stocks, more likely, than you will on XLK, and if I'm right, you make more on XLK than QQQ, but if I'm wrong, it goes the other way as well. All right, Tesla, that one, beautiful short right there at the downtrend line, negative divergence, earnings, and it's been moving steadily lower since, so big old check mark there for the post earnings drop on that one. Meta still has to roll off. Meta back tested, broke down, back tested the trend line, went up after earnings. So right now that I get an X on that one because we're above there, but that will go to a big old check mark for the bearish case if this is simply, which it looks to be right now from a technical perspective. Again, forget about everything, just purely looking at the charts. I see a very well-defined uptrend line, extremely long in the tooth, big negative divergences. We haven't had divergences like this since before the bear market started in a lot of these big tech stocks. Breakdown, hit support, back test, and now starting to roll over. So at this point, I think lights out for Meta under 290, 240-ish right there. Let's say 290, those recent lows. Call it about 289 or so. All right, SOXX semis, there it is. This is what you want to see. It's been resilient. We had this breakdown here, but I always talk about this. Sometimes you break down and that's it. You don't look back, and quite often, especially in a strong uptrend, you back test, and that's all the semis have done. So we had this smaller wedge I highlighted recently. break down, back test, back test, back test, and then this is what I always say. The problem with back testing or shorting a back test is you can continue to back test for a while and you go higher and higher and higher against your position. So what I like to see is finally an impulsive rejection off the back test, and that's what we have today. So that is pretty good. Next step, we need to take out the that recent low, about 507 or so, and that would take us down to my initial target here, the primary uptrend line 482. Next target 446. I think I gave you some targets on the 60-minute chart recently. There's breakdown one, second divergent high. I'm going to tweak this line right there. So now you can see we're coming up on some supports. Like I said, we're getting pretty oversold for today. We'll probably bounce. Plus, more so, Apple and Amazon are still coming up tomorrow after the close. So you'll probably see the dip buyer step in today, gobble this drop up, and then ultimately break that down, head on down to here to on the 60-minute chart. There's that T2 445.70 from where we're at right now. That'd be a drop of about 13%, and certainly the potential for a whole lot more based on these divergences, based on the long-term charts and everything else. All right, let's just move on to VIX. VIX, I think it was last week, I gave you this bullish falling wedge pattern on the VIX, nice and clean, positive divergence there, and boom, that triggered today on a gap up above there. So that's a buy signal on the VIX. The market rallies. Here's what I expect. So I got this out there this morning, and then I said when you're trading the VIX, best to use your entries and exits, based on what the equity markets are going to do. So if you already positioned in this for anticipation of a breakout, great. Would you buy right now? You can. It's a breakout. You can take it on face value and just buy and not try to second guess everything. But here's my thing. I think the markets will bounce today from where we're at right now, about where I started this video a little bit before, for the reasons I said earlier. And now we could get very well, and that would be an objective entry, a back test of the trend line. But from my experience, what we're seeing today, I had a lot of stocks break down. It wasn't just the S&P, which I'll get to in a second, taking out the trend line, or QQQ breaking support. I had a flurry of price alerts go off, and a lot of stuff breaking down. So what tends to happen is we can see a bounce in the market, and you may not get this. VIX is at a very low level, and just like the RR on the stock market is very poor, limited upside compared to the downside potential, on the VIX, same thing. VIX is probably best case scenario, or worst case scenario, probably just stays low for a while because we're down at the bottom of its range. The VIX is a range-bound little sucker. But so what I've noticed is on a day like today, we may not see much of a pullback in the VIX. I think there's going to be a lot of put buying, and that's what drives the VIX. It's the put and call buying. So we could see the VIX kind of hold up on this breakout, even if the market bounces, and whether or not it does, you still have a lot of additional targets. And I gave you don't trade the spot VIX, that's VXX. You can trade VIX futures, VIX calls on those futures, or one of these ETNs that just buys the futures for you, and that's VXX. There's others out there, and so there's your breakout. I gave you some potential targets, and hopefully that made sense. What I'm saying is, this guy is going to lose money over time because of rolling these futures and other expenses they have. So it doesn't do a perfect job of tracking the spot VIX, nor is it the same. The spot VIX is the spot VIX. You cannot buy the spot VIX, VIX, the VIX index, the VIX volatility index they talk about on CNBC and Bloomberg. That's the spot VIX. You can only buy futures on that spot VIX or options on those futures, or again, these guys that will do that for you. And VXX is buying the short-term futures. So right now it's up 8.76%, and the spot VIX is up 16%. So that's just know that they're not going to be the same every day. You have a medium term. I've covered this before. Medium term VIX ETNs out there. Let me move on because I want to cover a few more things. Let's talk about real quickly yields, bond yields. This is what I've been telling you to watch right here, and we do have a breakout. And this is, in my opinion, what's putting pressure on the markets. It was that combination of the downgrade from Fitch. But again, it was, this isn't anything new. Everything they said, if you read why they cited the downgrade, and Yellen, of course, dismissing it. Oh, that's no. We've got a plan with Biden to bring down our deficit. That's hogwash. The guy's the biggest spender we've had since I don't know. Let me not even go there. Talk politics. All right. So there's a breakout in the 30-year yield above that level I've mentioned before, and that's a breakout. Breakout's breakout. You still have these other highs. That breakout could fail, but that's pretty significant in my opinion. That's the level I've mentioned to watch. And then TNX, the 10-year, I think it's flirting with that. Yeah, it's still flirting with it. So it's not all-in moment, to short bonds yet. Right off the stock market. And remember, I told you before that we could see, yields up means bonds down. But if the stock market now starts to move sharply lower, especially big correction, impulsive selling, Treasury should receive some inflows as a flight to safety trade. There's a lot of cross currents now. Remember, it's not just Fitch's downgrade. The last debt ceiling increase, the Treasury is going to have to issue a lot more, and we know that. We know roughly how many more bonds they're going to have to sell new Treasuries to pay for that. We keep just borrowing more. And anyway, so again, like I said, it doesn't matter until it matters. And all of a sudden there may be that flashpoint where investors, and believe me, it's not just individual and U.S. institutional investors buying treasuries, a lot of foreign countries too. And at what point are they going to say, you know what, America, we don't think you're going to be able to pay off all that debt. We can see it's going in one direction. And we're not going to default on our bonds, but what we'll do is monetize that debt and just issue new bonds to pay for the existing. And if you look at the numbers, what our interest costs has increased already since this rate hiking campaign. In other words, the U.S. has to issue new treasuries and at higher and higher rates. Just like if you or I were to borrow money, you go out and take a car loan or a mortgage, and right now you're going to be taken out at a much higher rate than you would have a couple years ago. So that's going to further add to the deficit for the U.S. and it may affect the bonds. All right, this video is going a little bit long. I'm going to just go into the alerts that I had today, just for trade ideas. And again, the market's been resilient, and I know a lot of you from the comments have given up on wanting to short it, and some want to go long. And again, I've given you levels to buy, pullbacks to support. Now, one thing I always say I'm good at. It might not get the call on everything right all the time or on the markets all the time, but identifying key support and resistance levels, I think that's what I do a very good job of. And then trying to, of course, then I try to anticipate instead of just showing you here's support or resistance. I'll tell you my thoughts. I think this pullback to resistance is a buy, that we're going to go higher from there in reverse. So you want to step in and buy that support, pull back to support, or nope. I think when we go down to that support, I would be waiting for a break of that support to go short. And so you guys can figure out if you want to do that. This is CNDS. So I gave you a screenshot of my price alerts today. This is one of them, Cadence System. I haven't checked it for earnings yet, but that's a sell signal all day long. It's a breakdown. Now remember, I think we'll probably get a little pop-up today. They may close on the trend line. If you want to be safe, you can wait for a solid close below or a follow-through red candle tomorrow. You do have a first support level there at 220. So to me, it'd be maybe a starter position today or tomorrow or the next time we get rejected off there, and then a full position when 220 breaks. That's the support. First target's right there at 192.34. That's a drop of about 15, almost 16% from where we're at right now. Let's just focus on that one for now. This is an old level here. I haven't changed that support level yet. QQQ, got a price alert there because we took out the trend line, so that was in that thing I showed you before, but I've already given you my thoughts there. And let's just leave it at that. And we'll look at the 5-minute chart. We went a little bit below. This is support right here, but you can see there's also a reaction low right here, right there, and we're back above that now. So this so far we took out that previous reaction low, but now we're back above it, and that's a little whipsaw. So I think they'll, like I said, probably run this up today for the reasons I stated earlier. I also had an alert on MA, MasterCard. These are on my TTW watch list. I've shared that. Started a few months back. I put together a watch list that I've shared with you a few times in the past called Things to Watch. And this is one of them because that kind of gives you a gauge on the consumer, Visa and MasterCard. And Visa is just starting to crack. I had a price alert, but you want to see, sometimes you get these intraday breaks like that, and we close back on the line. So I wouldn't consider it a sell signal yet. You want to see either a solid close or a solid intraday move down below there. And if so, you can see my first couple targets there. For MasterCard. And again, it's just, it's this big divergence. This is why, what I was saying a minute ago. If I was bullish on this stock, I'd say here, and we're at support, buy the whole pullbacks of the trend line. And if you are bullish, there it is. There's your primary uptrend line. Buy this level. Based on what I'm seeing here, divergence or rejection, false breakout off this previous high right here. See, we tried to take it out, failed. This is one I'd rather wait for a breakdown and short this stock because I think it's going down there. I think the next 10+% on this stock will be to the downside before we get 10+% to the upside. So there's what it looks like. Let me just show you Visa. I'm here. Visa's still above trend, so and pretty important level there, 236.50 right there. Quite a few reactions on that. So this may prove to be a false breakdown, but this is the level that has to be taken out. And that would also increase the odds that MasterCard's going to drop if Visa breaks that comparable. It's just like MasterCard, a big old bearish rising wedge, complete with negative divergence. All right, the VIX I already covered. I'm just going through my price alerts here. USFD, U.S. Foods Holding Corp. Right on support. There's my benefit of the doubt level right there, 42.37. I got a sell signal price alert on it today, but really needs to take out this level. You can see it did it intraday again, but that's not a solid break by any means, and it's certainly, as of now, we're back above that BOD or benefit of the doubt support level. So let me keep it simple. Break of today's lows. Again, with all these short trades, you might want to wait. If you're a little more conservative, wait till Amazon and Apple are out of the way. It's going to increase the odds of these guys playing out. But I have a lot breaking down, and to me, the breakdowns appeared imminent before. They're starting to break down, and I have a pretty good degree of confidence they're going to go that way, whether they pop a little first and then drop, or just follow through tomorrow and into next week. TLT, I already covered that. I had a price alert on it today, and that's because I haven't updated TLT in a while. That was the same. Remember, TLT is like TYX, which is the 30-year yield upside down. So that was that comparable resistance level, which we popped through today on TYX that I covered earlier. And that's the breakdown in TLT. And remember, TLT, you're flirting with multi-year. If it takes that level out, then that's it. There's just not a lot left. That's a big support level right there. And again, that's the recent highs. It will be at new multi-year highs on TYX, the 30-year bond yields. We'll go back. See, this is the previous peak from back in 2022 right there. And if I take that level, come all the way over here, that would put us back to where interest rates were, where the 30-year bond was back in 2011, 2008, all the way back there. So powerful stuff, in my opinion. Something to continue to keep an eye on. Shack, SHAK. I've covered this one in my restaurant trade ideas recently. Shake Shack, beautiful bearish rising wedge, complete with divergence. BOD support level, benefit of the doubt right there. I mean, it already broke down. So it broke down, hit first support or target. It's been dancing on that level. This is a great example of how that support works. And then once that support level goes, boom. I don't see, I could give you, and I will, I'll give you an intermediate target for you active traders. We'll probably bounce here initially at 71. So this stock should do something along these lines. Like that. And quite possibly more. So let me just quantify it for you. That's my preferred swing target right now. That's about a 15% drop if hit. That's about 64.83. USFD, I already covered. ISRG. I had an alert on this one under 321. That's a sell signal all day long. I don't think this one's going to recover today, so there's an objective entry. I'd check it for earnings. I haven't done so. Targets 304.50, 290.50-ish. And then if it, which I think it will, enters that gap, big old gap right here, right? See that gap? 270.34. So that one has the potential to drop as much as 16% at least. Alrighty, I think, nope, I have one more, and then when we wrap this video up, BYD, Boyd Gaming, just yesterday and even last week, I went over PEJ, the leisure ETF. You have all these, casinos and restaurants and all those other things, and they're all looking the same. There's Boyd Gaming, bearish rising wedge going lower, Las Vegas Sands, MGM, rejection. I covered these yesterday, a lot of these stocks. Wynn Resorts, some of them have already peaked, like Wynn peaked back here on that divergent high. It's been stair-stepping lower. All right, let me wrap up here, and I'll cover the other stuff I wanted to as well, the euro and gold and silver and everything else I've been covering lately. I'll do that in a separate video. This has been Randy Finney with Right Side of the Chart. Have a great day.